The money you see in your bank account was never fully there.
The balance on the screen feels real, yet it represents trust in a system, not physical money held for you.
Banks appear stable because systems operate smoothly, reinforcing the belief that money is always available.
If too many depositors demand cash together, the system's weakness is quickly exposed. Behind the appearance of security, only a fraction of the expected money actually exists.
Secure storage reduced risk, but replaced direct ownership with trust in written claims.
Before modern banking, money existed as physical objects whose value was limited by scarcity.
Paper claims gradually began circulating as money, separate from the gold they promised.
Most deposits remained untouched, creating opportunity for risk, disguised as efficiency.
More claims were issued than gold held, relying entirely on continued public confidence. This marked the moment money became detached from physical limits. Written records allowed promises to be tracked, turning trust into an organized financial practice.
Interest transformed lending into profit, ensuring debts would grow over time. Private lending practices gradually formalized into recognizable banking institutions.
When confidence failed, banks could not meet sudden demands for withdrawals.
Financial collapses revealed how little physical backing existed behind expanding promises.
Governments intervened to stabilize banking systems vital to economic survival.
Central banks were created to support financial systems during periods of crisis.
Money creation shifted further away from physical limits through centralized control.
Most modern money now exists only as digital records within banking systems.
The entire financial system continues to function only as long as confidence remains intact. As lending increased, credit expanded far beyond the original amount of deposited money. Through repeated lending, a single deposit could support multiple layers of new credit. Each new unit of money entered the system as someone else's obligation to repay. Interest ensured that total debt would always exceed the amount of money available.
To keep money circulating, new borrowing became a permanent requirement.
As money supply expanded, purchasing power gradually eroded through inflation.
Asset prices rose faster than wages, benefiting those closest to credit creation.
Over time, wealth accumulated disproportionately among those controlling financial assets. Modern economies became dependent on continuous credit expansion to function.
The system appeared stable, but underlying risks continued to accumulate quietly. As credit expanded further, the system became increasingly dense and difficult to unwind. A single shock was often enough to disrupt balance across the entire system.
Perceived stability reduced sensitivity to risk, encouraging continued expansion.
Ordinary participants remained exposed to risks they did not control.
When liquidity froze, even functioning institutions struggled to operate.
Emergency interventions were deployed to prevent wider collapse.
Stability returned, but only through extraordinary support. Repeated rescues quietly encouraged greater risk-taking.
A single shock was often enough to disrupt balance across the entire system.
Daily life continued, dependent on systems few fully understood.
After each crisis, the system appeared repaired, but underlying weaknesses remained.
Lessons from past failures were acknowledged, then gradually forgotten. Regulations multiplied in response, adding complexity without eliminating core risks. Regulations multiplied in response, adding complexity without eliminating core risks.
Opacity increased, making risks harder to see before they emerged.
Most participants interacted with outcomes, not with the system itself.
Dependence on intervention deepened with each cycle. Over time, extraordinary measures became part of normal financial life. The long-term costs were deferred, not eliminated. Stability persisted, but only as long as confidence endured. In the modern system, most money exists only as debt recorded on balance sheets. When a loan is issued, new money is created without transferring existing cash.
In practice, loans are created first, and deposits appear as a consequence.
Physical reserves play a limited role in constraining modern bank lending.
Capital rules, not deposits, became the primary limit on bank expansion. Different assets carried different risk weights, shaping lending incentives. Liquidity rules aim to ensure survival during short-term stress. Risk management increasingly relied on models built on assumptions. Hidden correlations meant risks could align unexpectedly. Constraints existed, but they did not remove the system's underlying fragility. As credit expanded, pressure accumulated at the edges of the system.
Interest payments recycled money back into the system, reinforcing dependence. Debt accumulated faster than underlying capacity to repay.
Eventually, repayment capacity imposed limits credit could not ignore. Defaults appeared first at the margins, small enough to overlook.
Because obligations were interconnected, failure could spread rapidly.
As uncertainty grew, confidence began to erode.
Rising doubt increased pressure to withdraw funds simultaneously. Short-term obligations clashed with long-term asset structures. Short-term obligations clashed with long-term asset structures. At this point, stability depended entirely on confidence holding. When pressures converged, the crisis ignited abruptly.
Markets reacted instantly, repricing risk at speed.
Access to funding tightened as uncertainty spread.
Institutions sold assets rapidly to raise cash, accelerating losses.
Losses consumed capital buffers meant to absorb shock.
Doubts emerged over which institutions remained solvent.
Doubts emerged over which institutions remained solvent.
Banks became unwilling to lend even to each other. Payment systems slowed as liquidity evaporated. By this stage, stress had become system-wide.
At the threshold of collapse, extraordinary decisions became unavoidable.
Central authorities injected liquidity to stabilize failing markets. Central balance sheets expanded dramatically to absorb financial stress. Backstops expanded to absorb risks private institutions could not.
Financial risk was transferred from private balance sheets to the public.
Markets stabilized, responding quickly to intervention signals.
Financial risk was transferred from private balance sheets to the public. The expansion of money increased long-term inflationary pressure.
Public debt expanded to support emergency stabilization. Stability returned, but the system remained fundamentally altered.
Emergency conditions gradually became the standard operating baseline.
Temporary policies remained in place long after the crisis passed. Market behavior adjusted to expect future intervention. Asset prices rose faster than underlying economic output. Wealth concentrated among asset holders as inequality widened.
Asset prices rose faster than underlying economic output.
Debt became a permanent feature of everyday economic life. Resilience declined as leverage increased across the system. New vulnerabilities accumulated quietly beneath apparent stability. The cycle continued, altered, but fundamentally unchanged. The cycle continued, altered, but fundamentally unchanged.
Emergency conditions gradually became the standard operating baseline.
Temporary policies remained in place long after the crisis passed. Market behavior adjusted to expect future intervention. Asset prices rose faster than underlying economic output. Wealth concentrated among asset holders as inequality widened.
Asset prices rose faster than underlying economic output.
Debt became a permanent feature of everyday economic life. Resilience declined as leverage increased across the system. New vulnerabilities accumulated quietly beneath apparent stability. The cycle continued, altered, but fundamentally unchanged. The cycle continued, altered, but fundamentally unchanged.
Economic stability became increasingly dependent on continued monetary support.
Repeated rescues reduced the consequences of excessive risk-taking.
Repeated rescues reduced the consequences of excessive risk-taking. Confidence in institutional control began to weaken.
The range of effective policy tools narrowed over time. Over time, the system became less capable of adapting to new conditions. The system appeared stable, while underlying fragility increased. The long-term costs of stabilization became increasingly visible. Dependence on intervention became embedded within the system itself.
Understanding the system did not end it, but it changed how it was perceived.
Across centuries, the underlying structure of money creation remained consistent.
Money moved steadily away from physical reference toward abstraction.
The system functioned only while confidence remained intact.
Economic activity relied on continuous expansion of debt.
Individuals carried exposure to risks they did not control.
Understanding the mechanism removed the appearance of mystery.
Not all forms of wealth responded equally to systemic stress.
Awareness led to strategic adjustment rather than withdrawal.
Preparation reduced exposure without requiring disengagement.
The system persisted, but understanding changed how it was navigated. Once observed clearly, the system revealed its internal logic. Stability at the surface concealed ongoing structural tension. Confidence functioned as the final stabilizing factor. The system followed a recurring cycle rather than a linear path.
Positioning reduced exposure without exiting the system entirely.
Awareness altered response without changing the system itself.
Apparent calm did not eliminate underlying instability. Exposure accumulated over time, even during periods of stability.
The system advanced through momentum rather than deliberate control.
Understanding the system reduced surprise, not risk.
Despite repeated warnings, the system continued without interruption.
Consequences emerged slowly, long after decisions were made.
Responsibility became dispersed across institutions and processes.
Instability became normalized within everyday expectations.
Risk accumulated quietly beneath apparent stability. Risk accumulated quietly beneath apparent stability.
individuals remained exposed to outcomes beyond their influence.
Awareness allowed preparation without false certainty.
What remained was not a secret, but a structure long accepted. Understanding did not end the system, but it ended the illusion.